many pivot points that take place. Micro pivot, we've talked about macro pivot points. In the past, we've done entire sessions on how to define micro versus macro pivot points. At a very high level, if you're brand new, you're saying, what is this micro versus macro? Micro is any time kind of you see these small little pivot points that take place. Macros is like the larger, more obvious changes of direction, okay? At a very high level, that's how you can look at it when you're in the beginning. Now, we can get much more precise about how we specifically define these, but in the beginning, start there. Look for the obvious changes of direction, these obvious areas where prices change direction, and then utilize those kind of things. Now, today, as we talk, I really want to identify what are the zones that are most relevant. And so I kind of want to go through a little exercise with you to illustrate both the problem of identifying too many areas of resistance, as well as how we can filter through them to know which ones are most relevant in the short term. This is a very common question we get, so I want to illustrate this to you. So what we're going to do is we're going to jump up a time frame. Not just one time frame, we're going to jump all the way up to, say, a daily time frame. So we're still on gold, but each one of these candles represents 1 day of time. And we're going to add a few lines onto our chart. And we're going to say, all right, make sure I push the right button here. We're going to add a few lines onto our chart to just represent just some general areas of resistance that we can see on our chart. And so essentially what we've done is we've identified a few key areas. We can say, hey, price came down here, responded, came down here a couple times, responded, came up here several times and responded, came down here, responded, came up here, responded. So we look at these different areas and so at a high level view, we've now created areas of resistance. Now, all of these are very relevant. We can say price responded in these specific areas based on some of these recent pivot points, but it's based upon this daily time frame chart. So let's create a vertical line as well on our chart, just so that we don't go too, or kind of to keep your eye oriented with how far back we're actually going in time. In fact, I'll go all the way to here, since this was basically the first top pivot point that we were considering on a daily time frame chart. So as we drop down to a 4-hour time frame chart, if we zoom back out to make sure we're looking at the same data, we can see our vertical line. Here's all the information that we're looking at to the right. We're only considering information to the right. And so I'll put it an arrow even here just to kind of remind you of that fact. So everything to the right is what we're looking at in terms of resistance. So now that we have more data based on a 4-hour time frame chart, do we see more areas of obvious resistance? I'm seeing quite a few right off the bat. So if we just start drawing some lines and we start even just here, we can start to put in some additional areas of resistance. We can say, okay, price was there, it responded there. We've got all those accounted for. There's one up here. We can say that there's one even down there. And you already can start to see how even based on just 2 time frames, that this can start, oops, I didn't want to do a vertical line there. Let's delete that one. All of a sudden, we can start to get way too much information on the chart. Because now, even just with these 2 time frames, a daily and a 4-hour, if we're considering all of these previous pivot points and areas of resistance in the past, here's another pretty good one right there. All right, even just back to this vertical line, you can see that this starts to get really confusing. Because now how do you make a decision? Because in the end, what you'll find is that like you could probably lightly see just these light kind of grayish horizontal lines that are on the chart by default, just on TradingView itself, that you'll find that there's resistance pretty much at every one of those levels. And so do you then make decisions at every single one of those levels? Well, that becomes pretty cumbersome and it makes it very muddy in the waters to be able to clearly make a decision. We've only looked at 2 timeframes and we have all of these potential areas of resistance that are very valid. These are areas where the price has responded in the past. If we go even further, let's drop down just one more time frame just to really hammer in this principle. So now we're looking at 1 hour worth of time. You can see all of our areas of resistance based on daily and 4-hour time frames. Here's our vertical line to show all this information to the right is what we're considering. And so if we drew in more areas of resistance, areas where price has responded, we could say, okay, well, if we start here at the bottom and just start drawing these in, we can say there's some support and resistance there. That one's mostly marked. We can see one there. We can see one here. Right there is another one. Here is another one there. And you could just see that how this builds into a massive, massive problem. Right? Without even including that much time, relatively speaking, How then do we determine which resistance level is important? And so we've created rules to help you understand which ones to look at. Because if every area of resistance that has ever occurred in the past, well, pretty much if you drew a line at every single one, it would end up looking basically like this. It would just be one solid color of shaded area, because literally every price level in the past at some point in time likely has been an area of resistance. And so we can't consider every area of resistance in the past. If we continue this exercise and we went down to the 15-minute chart, we draw even more lines. If we went down to 5-minute, 1 minute, it would just get ridiculous. And so how then do we filter through some of these, and how do we know which ones are actually relevant? Well, the short answer is that the areas of resistance are relevant to a single time frame primarily. It's not to say that it won't respond to it on a lower time frame, but because we have a time expiration affixed to each and every trade that we take, then we have to consider how long it's going to take for that price to move in that given direction. And so we do so within a given time frame. Meaning, if we are going to look at the daily time frame and we're going to consider its primary areas of resistance, then we're going to base our trade length on that daily time frame. If, however, we're going to use the 4-hour time frame and we've identified certain pivot points, areas of resistance, and we're going to look for trades based upon those, then we're really primarily only looking at the 4-hour time frame chart. We might consider one step higher. We've taught this as a multi-time frame analysis or a top-down analysis approach, where you can use one time frame above the given time frame that you're basing your trade on, just to get some basic areas of resistance that you can look for. And that is a valid approach to the marketplace. But you can see that if you use too many time frames, it just really starts to get messy. And without even any indicators on your chart at all, okay, then ultimately it starts to get really messy, right? Even if we just add, for example, the Bollinger Band and our classic RSI, it's like, how do you even see anything? How can you really make a decision? If we look at even the current price movement, we say, well, it's at a line, so do we take a put or a call? You see the problem, how it begins to unfold. And so, so let's break this down on how we then go about identifying those areas that are most relevant. All right, so we're going to delete all these lines, clear up our chart. We're going to go back to just a chart with no indicators at all for the sake of this analysis. So the simple answer is, here's the rule. Write this down if you haven't already. And that is, the most relevant point of resistance in the market is the one that is on the time frame chart that you're analyzing and basing your time expiration first. That's the first rule. Okay, so if we're on a 4-hour, then that means our time expiration is probably going to be, if we're doing a 3-candle rule, it's going to be 12 hours long. If we're looking at a 1 minute or a 5 minute, if we're doing a 5-minute chart analysis and we're looking at this data, and we're going to identify areas of resistance based on this time frame, then our time expiration and the most relevant area of resistance will have to be seen on this time frame as well. Okay, and the time expiration length will also be dependent upon this time frame as well, meaning it'll be like a 15-minute trade, or you could, again, we teach the 1-minute candle rule, where you can take essentially one candle's worth of time and then add additional rollovers if you need to, if you have a broker that allows that. All right, so so that's kind of the first rule. Second rule is you want to look at the most recent pivot points. And so let's just use this 5-minute time frame chart to kind of illustrate this example. So we're going to add a few lines onto our chart to illustrate where are these most recent pivot points, okay? All right, we'll just use 2 lines. So we can see that price has kind of been moving up, right, during this time. And there's a couple of times where price sort of pivots a little bit, but these are more what I would consider to be generalized micro pivot points. They're kind of smaller pivot points. In other words, if we were to compare the significance of the pivots, this move here, okay, so this single V shape is a much more significant directional move than this V right here, where it comes down and then up. You see that? Okay, so this small little V is much smaller than this overall V. So this larger V of the 2 pivot points is what we consider, generally speaking, to be the macro pivot point, or the primary pivot point that we're considering. And so while we're doing that, then as we're going to take this blue line and we say, well, where is the pivot point that is of most interest to us? We want to look left of our current price and say, where is it going to be? And this one here is the most recent relevant pivot point. Okay, because that is where price had responded most obviously in the past. Price came up here, came down, up, and then it went down from there. So that becomes the most recent relevant top pivot point. Okay, so if we label this, we can say this is our relevant. So this is the most recent top pivot. It doesn't mean it's the only top pivot that exists in past price movement. We can certainly identify others. We could say, well, this one was a pretty good one here. This one was a pretty good one here. This one's definitely a pretty good one here. So we have other top pivot points. Even this one right here is obviously an excellent top pivot point. So all of those are valid, but they're not the most relevant. Okay. And so as we look for the most relevant ones, we need to look for the most recent. Okay, so the most recent equals the most relevant. So that's the most recent top pivot point. In contrast, what is the most recent and relevant bottom pivot point? It would be this one down here. Okay, so this is most recent and relevant. I guess we have relevant, right? Relevant bottom pivot. Okay, and we can even add that wording in here, recent or relevant top pivot. So as we've identified the most recent relevant bottom and top pivot points, now at a macro scale, we have some areas that we can consider. And now we have filtered out every other possible area of resistance on every other time frame. Now, this is not to suggest that those other areas of resistance don't exist, but you can find yourself totally confused by adding too many areas of resistance based on all manner of time frames, different resistance lines, different trend lines, etc., to where you become paralyzed and you don't know where to make a decision. Because here's the truth. Because price moves up and down continually on every single time frame that exists, there are going to be good, valid reasons why price will go up and why price will go down at any given moment. And the truth is that both can actually be true. Price can go down within a given amount of time, and then it can also then go up in a given amount of time. So both statements can be true simultaneously. You say, well, no, price can't go up and down at the exact same time, and you're right, but it can be true. You could say price will go up in the next 5 minutes. Price will also go down within the next 7 minutes. Okay, so when affixed to a specific time frame, both statements can be true simultaneously. In other words, it can go, in effect, both directions within a given amount of time. So that is why we look at the most recent or relevant top and bottom pivot points in the market, or these areas where prices change directions, because this gives us something to go off of. So we can say, hey, if we have a breakout above a top pivot or below a bottom pivot, then we can look for areas of interest where price might come back down and respond. And this is where our little zones can be handy. So you can come up to this top pivot point, come up to the wicks, extend this out. And now we have a simple zone to where we can say if price comes down into this zone and if we get proper confirmation that the price will continue in the upward direction, then we might take a call option trade. This breakout to the upside right here gives us some evidence to suggest that price might come down to this area and then go up again. So an area of resistance acts like a backboard in basketball. That basketball hits the backboard and then it bounces off of it. So if price is above an area of resistance, it comes down to it and then bounces up. If it is below it, so I would say if price had broken down below this pivot point down here, it will likely come back up to it. And as a backboard, what would it do? It would bounce downward. That's essentially the directional prediction that we would be making. And so this becomes a very natural framework that you can use over and over and over again. And the better you get at identifying these levels, the opportunities present themselves constantly, both on a micro scale as well as a macro scale. Now, for the purpose of today, we're focusing mostly on the macro view. We're not considering every little micro pivot point because that, like all of the other resistance points on every time frame, can really muddy the waters and make it confusing and hard for people to kind of keep things straight. And so for the most part today, we're focusing exclusively on the macro view, meaning these primary pivot points or these areas of resistance where price will likely respond. Now, is this the only area that price might respond to? No, it is not. There are other areas as well. For example, based on institutional candle theory, if we look at this downward leg, what is the last downward candle in this downward move before price began to go up? It is right here. So we could take our rectangle and actually draw this out. About right to there, perfect. And so this red candle here is the banker's candle, which is the last downward candle before this upward move. And so will price come down to it? We cannot say, because we cannot, in a sense, predict exactly what the future will do. All we can do is set up if scenarios to say, if price comes to this area and if price gives us this specific pattern, then we'll take the trade. So we set up a scenario where we have conditions upon which we can make a decision. We do the same thing in medicine, in engineering, in construction, in many areas of life, to where we say, if a person does this or if something does that, then this happens. Even think about something as simple as driving out on the road, and there are police officers driving out on the road as well. And those police officers have a set of rules that they follow, a set of conditions that they're looking for. And they say, you know what, if a person exceeds the speed limit by X amount, it could be 1 mile an hour, 5, whatever it may be in their rule book, or however their decision-making process is, then they say that's when I will actually pull them over and give them a ticket, right? If they are driving all over the freeway and they're crossing over lines, they're not using their turn indicators, et cetera, then they might pull them over and say, hey, you're committing reckless driving. So they have rules that say, if you do this, then I'm going to pull you over. Then I'm going to give you a ticket, et cetera. But they don't just randomly, at least we hope, just pull people over and give them random tickets for no reason at all. And so in a similar way, we look at the market and we set up these if scenarios, these conditional based scenarios where we say, if price does this, then I will look for this sign. And if I see that, then I'll take the trade. So right now, for example, as price is up here, have we taken the trade yet? No, we have not. Price is moving up. And I know for some people, especially if they feel fear of missing out, they're saying, oh, but this was just perfect. And I can see that it came down to this pivot point here, and now it's moving up, and I could have already won the trade. And it's this line of thinking, and I'm not suggesting that this doesn't work. Okay, you can do whatever you want. And I know many people who would say, well, this was an area of resistance here, and so I could have taken that trade for 1 minute and won, or I could have taken this for 3 minutes and won, or whatnot. And they would be right in that is one way to approach the market. We're not saying that it is impossible or that it doesn't work, but what we're suggesting is that if you want to simplify your analysis, if you want to simplify the analysis of the market, then you need to know what your rules are. You need to have some kind of system to go on. Otherwise, you're really just led by emotion. Oh, here's another resistance. Oh, there's another one. And you end up like we showed in the beginning with just an infinite number of lines on your chart, and you're constantly in turmoil over which direction the price will go next. And you're looking for every little sign, every little symptom of which direction it might go. You look at every little green candle, think, oh, I think it's going to go over, put in a call option. And what you find is emotion is then ruling your decision. Imagine a surgeon functioning in a similar way, sitting there in the ER or in the OR, right, performing surgery on an individual and operating based upon emotion. And they begin to cut the patient's skin. And if you're squeamish, I apologize for this description, but they go in there and they see some blood or they see this and say, oh, you know what? I don't think this is going to work out. And they start doing something else and they start sewing things back up and they're using the wrong suture and right? All of a sudden it's like, holy cow, does this person even know what they're doing? Do I trust them? Are they going to create consistent outcomes? You know, they say, hey, my spouse is calling me and now I got to go over here. It's like, no, you're in the middle of a surgery. You got to focus on the rules because a person's life is on the line. But when we trade, sometimes we kind of take a similar approach. We say, yes, my money is on the line, but I think it's going to go up, or I think it's going to go down. And we allow emotion to rule those decisions. But what will provide you with patience and an ability to both accept the win when it occurs, as well as accepting a loss when it occurs, is following some rules that you can have confidence in. And so part of what we teach you in this course are those rules, that objectivity that you can follow in order to feel confident in your trades. Okay, so with this type of situation that we're in right now, price is kind of hovering in this zone, but it has not yet come back down to retest this recent macro pivot point. So do we have a trade yet? General answer is no, we don't. And so we won't until prices come down into this zone and then given us a good reason to take the trade. Now, let's just address the natural question at this point, which is, will I be guaranteed to win this trade? If it comes down, let's just say it gives us a nice confirmation candle, bullish engulfing, it's a break of structure candle, everything's lining up, am I guaranteed to win that trade? The answer is no, you're not. And that's an important element and thing to consider and to accept, because you will not win 100% of your trades. Now, I know that's very difficult to hear, because all of us, when we came into the world of trading, whether consciously or subconsciously, we believed that we could win all the time. And proof of that is, look at how people respond when they lose. Whenever they lose, how do they respond? How do they feel? What is their reaction? They're thinking, oh my gosh, I lost. I don't know if this is for me. It's too scary. I just lost some money. I think I want to quit. Oh, my Uncle Bill, he was right. He said this thing doesn't work. Oh, my Aunt Jane, she said that IM was a scam. This proves that she was telling the truth because I just lost a trade. You see the line of thought? All of the emotions begin to take over, all because you lost one trade, or maybe you lost two trades, right? And so rather than letting emotion rule over you, you have to become objective about your decision-making process. Now, are there people who act very instinctively? Yes, Ness actually is a great example of that. Ness, I would definitely consider him to be an expert trader, and he has developed his own kind of instinctual-based trading system that he goes off of, and he loses a ton. If you watch any of his sessions, he actually loses a ton, but he wins more than he loses, and he wins overall. He ends up profitable, in other words. And so seeing that, the question then becomes, can you duplicate that yourself? Instinctive-based trading that's highly based upon just live analysis of the chart, it's not that it doesn't work, but it's very difficult to duplicate. In the very beginning, when Brandon and I were testing out HFX, we actually were following Ness and some of the other educators, and we were looking at their different styles, strategies, and approaches to doing HFX, and we've kind of found that for ourselves. We found, wow, they obviously know what they're doing. They're really good at that particular style of trading, but boy, how do you get somebody else to do that exact same thing? Now, if you want to take their trades, follow along with them, that's great. It's super fun to watch a lot of times. I've never seen anybody do larger trades than Ness does. He's amazing. But having said that, not everybody can duplicate that same kind of instinctual level or style of trading, and that's okay. And so what we teach here is how to be objective and measurable and kind of slow things down a little bit on how you go about making your trade decisions. So once you've analyzed the chart and you've made your decision based upon that given time frame, note that we have stayed on this 5-minute chart the entire time, okay, in terms of drawing out this specific analysis. So we've been able to say these are the recent pivot points. We have a breakout to the upside, price is coming back down. And so if we get the proper trade entry reason, then we could take a trade. How long will this trade be? Well, first option is if you want to take a one candle rule approach with the ability to roll over, you could take a 5-minute trade. You could take a 3-minute trade if you wanted to shorten it up a little bit. That's kind of what Taylor and Matt often do, which is also a valid approach, with the ability to roll over. That is the condition, okay? Because if you're counting on one candle to move in your favor, that's a pretty tight prediction. And it may not move in your direction just at that first impulse. And so having that ability to roll over if you need to, if you want to take a little bit shorter trade, just make sure that you have that ability on whatever broker that you happen to be using. If you don't want to take that approach, you can take a confirmed trade entry reason or preemptive for that matter, but take a 3-candle rule trade, which is just one option, but it gives you 3 candles worth of time to go in that direction. So in this case, it'd be a 15-minute trade because we're looking at a 5-minute time frame chart. So that's the line of thought, that's the psychology behind it, and that becomes your objective rule. So make those decisions up front so that when the trade presents itself, as price comes down to that level, you already know what to do. Because if you haven't decided in advance, once again, what are you left with? Emotion. Now it comes down there and say, oh, Is this the time? All right, am I in? Should I push the button? And now you're filled with fear, you're filled with anticipation, doubt, all sorts of emotions. All the rules go out the door, and you just make a quick decision. And that's not a way of consistently making money in the markets. And so being objective about it allows you to be patient. It helps you to develop patience as well as confidence in your overall strategy. So as we're looking at this particular scenario on this time frame, we've set up everything that we really can set up in order to make a solid decision. And then whatever happens, it happens. If you win the trade, fantastic. If you lose the trade, that's okay too. Because it doesn't determine your long-term success or failure in the market. It simply determines what happened on that one particular outcome. We get messages all the time from people, and we welcome these messages, but they say, hey, I lost this trade. What happened? And sometimes the feeling or expectation is that I'll never lose a trade. And again, we're not beating anybody up when I say that, but just encouraging you to remember that trades will happen, and that's okay. It happens for Brandon and I. Taylor loses trades, Matt loses trades, DL loses trades. We've all lost trades plenty, all right? And so it doesn't mean trading doesn't work any more than getting a ticket on the freeway means driving doesn't work. It just means that you maybe that just things didn't work out and you got a ticket or whatever, right? So, and anyway, let's go through some different scenarios. So with this, we've looked at the 5-minute time frame chart. So let's look at a different pair altogether. Let's go down to, let's just do the euro to US dollar. Okay, this is another random pair. Really, we could choose anything. And let's go through that same kind of thought process or analysis. Now, anytime you're looking at a given pair, it's always good, again, to know what time frame are you analyzing. 5 minute, 1 minute, whatever it may be. And then just kind of conscientiously note to yourself, how much time am I going to consider for this specific trade setup that I'm going to look for, right? That becomes the starting point for your trade decision. You got to make sure you note that in advance. That way you can go into your broker, you can select that time frame and say, okay, if it's going to be 1 minute, if it's going to be 5 minutes, if it's 3 minutes, 15 minutes, whatever that may be, decide that up front. Make sure you set it into your broker that time expiration. That way, when it comes down to the actual moment to push the button, we've seen plenty of times people end up pushing the button. They go, oh, I was supposed to do a 15-minute trade and I just did a 2-minute trade because they forgot to change the settings. And so look at the time frame, make sure your settings in your broker are appropriate to match up with that, and then begin your analysis process. That way you don't have to think about it later on when you actually execute the trade. And then as you begin to look at the chart, sometimes it's helpful to look from the left and begin to kind of to see the overall structure. So we can say, okay, price went up to here, basically went down to here, up to here, down. And so here is where we're at. And you'll note that I skipped over some of these kind of smaller pivot points in each of these legs of movement. And that's done on purpose because to, again, look for the primary areas where price may respond. And so right now, if we then look at current price movement, that little exercise there, drawing these pivot points, just kind of gives you a basic idea for where price has been in the recent past. But then to look at the most relevant top and bottom pivot points, we need to look at where the price is at currently in relationship to the past price movement. So we can do a vertical line here, and then we're going to look to the past to identify where these pivot points are. So our first one that I would identify is there. Why? Because we have enough downward movement to suggest that this is actually a pretty good area of resistance. And a secondary to that, I would say down here. Let me grab this line. There we go. Okay. Now note we put lines instead of zones. Again, this is just a starting point. This is just to get a basic idea for where your top and bottom pivot points are. So we essentially identified this as this is the most recent and relevant top pivot. This one down here is our most recent and relevant bottom pivot. So note how by taking this approach, you can literally enter the market, meaning enter it into an analysis process any time of day on any given currency pair, any given asset type, commodity, gold, whatever. And you can look at this and say, all right, where are the most recent and relevant pivot points? These are the areas of resistance that I want to pay attention to. Because what I want to see then, especially if I'm looking for a continuation move, is we can create our if scenarios here and basically say, that price now needs to simply break out either above that top pivot point. We'll look for some kind of retest and a continuation move, or price will break below here, come up, and then go down. So all of a sudden now, all we have to do is wait. We've identified our most recent areas of resistance, and now we can start to think in terms of where are the zones or areas of interest. Well, for right now, because price is in the middle of 2 pivot points and we don't yet have a breakout, all you can really do is say, well, here is a zone down here. And this is going to look pretty narrow because these wicks aren't very tall. And here's a zone up here, and we're going to run into the same thing. These wicks are very, very short on this, so it only is about 2 there. So it's basically no better than drawing the lines in this particular case because the wicks are not very long. And so those are really the only zones that we can look at right now. If you want to look a little bit bigger than that, you could say, well, price definitely broke out below this level here. And so price may come up to there before pushing down. And so that is a secondary consideration. But if you're just looking at the most recent information, the most recent, most relevant, you want to simplify that picture, keep your eye on these most recent pivot points. Now, this may take quite a few candles. If we look at this most recent upward move, let me grab my time tool here. From this point here to this point there, that's 1 hour and 25 minutes just to create this upward moving leg. That's quite a long time. And when people are waiting for a trade to set up, it can feel like an eternity, right? And so one way to speed up this process, if you find yourself emotionally feeling like you're in that position, is drop down a time frame. So instead of looking at the 5-minute time frame chart, say, you know what, this is just going to take too long. This could be an hour or more until I even have a trade set up. So if you need to go a little bit faster than that, drop down a time frame. This is why you'll see Brandon and I often on a 1-minute time frame chart, because we get more setups in less time. It's the same rules, same principles, but just that it happens a little faster. And so here you just go through the same process. Start at the left side of your screen. Here we're on a 1-minute time frame chart, and you don't have to go super far back if you don't want to, but just look for the most recent pivot points. We can see price push down, kind of meandered here, kind of consolidated for a little bit, pushed up, down. We're going to consolidate, or we're going to merge some of this information. Again, micro pivots versus the macros. Here, there, this one already came up. And so we're kind of in consolidation for right now. Okay, so that is where the price is currently at. So if we now look at this recent price movement, based upon the primary areas of resistance, where we got the most rejection, just to compare a couple of these, when you look at a couple of these downward moves, they're kind of smaller than this one here. That's why I consider this to be kind of more of a primary downward move. Similar, this is a little downward retracement, but this one here is a much larger downward move. That's why I consider that move to be more of a macro or primary pivot point as opposed to these other kind of smaller ones. And so as we look at price movement currently where it's at, let's draw a couple of pivot or a couple of resistance lines. So we can grab our line tool and we say, well, there's definitely one here, definitely one here. And so where is price currently at? It's in the midst of a little bit of this consolidation. No, kind of like we talked about yesterday, we've got some of these little doji candles, these little flat liners. What does that mean? When you see a lot of little flatliners surrounded by tall candles like these, immediate giveaway that you're during a time of day of low volume. Low volume means low participation, which means you might get stuck with some flat candles. Okay, so generally speaking, you want to be very mindful and cautious around times where there's low volume, because all it really means, it doesn't mean the market or anybody's out to get you. It just simply means that you're not going to have as consistent and timely movement as you would get during higher volume times of the day. And because like here in the past, you look through all of this movement activity from this morning, you really don't see that kind of flatlining activity anywhere, because there's a lot of participation. There's a lot of financial institutions investing in the markets. So you're going to get better movement. And so seeing these 4 little dojis, one after the other, is a pretty dead giveaway that there's some low volume going on. All right. Doesn't rule out everything, but just kind of be mindful of that. All right. So at this point, where is price at in relationship to past relevant pivot points? Well, we have price right here. Both of these pivots are at the same location. So you can almost go like this. You could take this line, bring it forward and say, okay, this basic line is our most relevant top and bottom pivot points. And so what do we need? We need a breakout either below this area, some kind of retest either to this level, or it may come all the way back up to this banker's candle here, the last upward candle in that upward leg, but ultimately with a prediction that price will go down. If we are looking, straighten that out there, perfect. We also could consider a breakout to the upside. But what we have done effectively is we have defined, but by looking at these recent pivot points, these recent and most relevant areas of resistance, now we know where to look. It's like being on a trip and somebody says, you're going to take an exit that's going to lead you to your destination. And you say, well, where's the exit? Is it at mile 5? Is it at mile 500? Is it at mile 5,000? Where is it at? I don't know, but it will go in your destination, right? You would never be able to get there because you don't even know where to look. And so by identifying these previous areas, these pivot points, now you know where to look. Now you have immediately drawn your attention to the right area where price will likely respond. What is that based upon? That's based upon the belief or based upon the past evidence that says, well, price responded there in the past. Price responded there in the past and is responding there currently, right? And so as we see that evidence, then that suggests that if price breaks out in either direction, it will likely come back to that same region and respond again. Again, everything is evidence-based. We look for that evidence to formulate objective trade decisions, and that will help you to create consistency with your trading. Now, as we consider all of these things, and I recognize that we're drawing a lot of this just on a blank trading view chart, but understand that all of these principles, all of these tools and things that we mark up are also useful directly in the IM Academy strategies. These strategies themselves are very useful at further confirming some of this information. But like here on Cash Trap, for example, if we're looking at any of these, I guess we're on the euro to US dollar. Let's look at that right now. Now, as we're looking at the euro USD, it's the same exact information as we're looking at on TradingView, with the exception of we might be looking at a 1 minute versus a 5 minute or whatever, right? And you can actually come in here and you can drop this down to a 1 minute time frame chart and be looking literally at the same information. You can see those same little doji candles right here, okay? Now, based upon the data feed, I know some people are gonna be asking this question. They'll say, well, why are there more little dojis here than we were seeing on TradingView? Depending on the data feed, so this is KOT4X. That is the data feed that provides the information for these candles. The programmers have found that these are very reliable at coordinating with TradingView for most pairs. Doesn't mean it's always perfectly in sync. If we look back at euro US dollar here, where is this data coming from? This data is coming from FXCM. This is a specific broker. And so if you see that there's a little bit of a discrepancy, you say, hey, these candles look slightly different than what I'm seeing here, that's okay. Look at the general areas. We don't get too hung up about the exact positioning or even the exact price level on each data feed, because the reality is there's many data feeds. If we type in Euro USD on here, you'll see that there are many different feeds. I guess this one, oh, that's showing just the Forex one. Hold on a second. Oh, well, I'll just do this. There you go. So all of these are showing different brokers and exchanges that provide various data feeds. And so anyway, the point being is that don't get too hung up if you see these being slightly different than what you see on your normal TradingView chart. It all depends on where that specific data feed is coming from, okay? So in terms of making decisions though, all the same rules apply. So let's just jump through this real quick in about 2 minutes to illustrate how this would work. Let's throw a couple of lines here on our chart. In fact, in Cash Trap, you hardly even need to because it puts the horizontal areas of resistance on the chart for you. But let's just do this just for repetition's sake. So we can identify a couple of these pivot points. So we've said basically the price has come down, up, down. So we're in consolidation right now. So these are the two areas that are most relevant and recent to us. So once again, we're looking for either a breakout above or a breakout below and looking for those opportunities. All right. So that becomes the reasoning and rationale. And you would see this would correlate with this nice green resistance line here at the bottom of cash trap, et cetera. And so you can use a final trade entry reason as a given call or put score. You can look for a confirmation candle, breaker structure candle. There's a number of trade entry reasons that you can utilize, but you can see on here that you can basically identify those same principles, those same areas of resistance directly in the strategies, and then look for price to make that move, combine it with further confirmations with the stochastic or other indicators, and you'll have a very solid setup on your hands. So anyway, hopefully you've been able to learn some good things from this today and clarified which pivots to even pay attention to. Because the reality is when you look in the past, you say, well, there's a bottom pivot, there's a bottom pivot, there's a bottom pivot, this one's right here, that one's one right there, here's another one, here's another one. We've just done the bottom pivots. Okay, all of those are valid bottom pivot points just in the recent past. We could see all of these little top pivot points. And so with so many, it becomes very easy to get confused, to get lost. And so my recommendation is look at the most recent and relevant macro pivot points, which I would define loosely for the purpose of this training as the primary areas of where price is changing directions. So if you see little pivots inside, disregard those, look at the primary areas. This overall movement here is much more significant than these little movements inside, okay? So the price is always gonna move in waves at every level. Look for the primary moves. That will give you the most relevant areas of resistance, and those are the ones you're gonna wanna base your decisions on, especially as you're first starting out. It's not to suggest that people don't make some pretty good decisions on the micro pivots, but that's just sort of down the road for a lot of people. That's kind of more of an advanced approach to the market. So in any case, with that, we hope you have a fantastic day. Thanks for tuning in. Always make sure that your teams are plugged in. And I'll just close with this. Again,